For me, it's a classic bear market look. You have a big cut, 6 months worth of down, and then you always have these snapback rallies. That happens a lot. Then after that rally, which is where we are now, then you take a slow grind down. So I suspect that everything that was bought in July will end up at a loss again. So we'll see.
Hey everyone, this is Elijah K. Johnson with Liberty in Finance. And back with us today is Ted Oakley from Oxbow Advisors. Ted, thank you so much for joining us today.
Thank you, Elijah.
Well, it's great to have you. Last time we had you on, you were talking about how we are headed into a bear market. It seemed like we had just seen the beginning of a downturn in the stock market. Since the last time we had you on in late April, we're down 3,000 points in the Dow. Your perspective on where we are right now and the current economic environment?
Well, Elijah, what's happened, it's really, for me, it's a classic bear market look. You have a big cut, 6 months worth of down, and then you always have these snapback rallies. That happens a lot. I could give you, particularly the last 4 or 5 major bubbles in the U.S. Did that, and people get to thinking, well, it's all over, but it's really not. And so then after that rally, which is where we are now, then you take a slow grind down, and it usually takes a long time, 2 to 4 quarters, and you wear people out over the next year or so, maybe 18 months, but it's a time frame that they're not ready for. And I think we're in the middle of that right now. So I suspect that everything that was bought in July will end up at a loss again. So we'll see.
And you've talked about quite a bit that the way to play a bear market is to control risk. How do investors really do that?
Well, I've been at it a long time and been through a lot of bear markets, and really the only way you can control risk, I mean, you can go to other sectors maybe. People will try to tell you can do this, that, or the other, but the true way to control risk is to have a high degree of liquidity. That's the perfect way to control risk. Now, you can keep it in short term. You keep it within a year or a year and a half if you want to, but you have to have liquidity that doesn't get affected, because what happens in bear markets is they end up selling everything because they need liquidity. So they'll sell the good stuff, the bad stuff, but they can't sell short-term cash. And so that's how you really protect it. And then you get to a point to where your cash levels are really high, like ours are right now. So that's the true way you get through the bear market.
I think a lot of people are hesitant to hold cash right now because of inflation. What do you say to the people who are concerned about holding cash?
Well, I would give them this way to look at it, Elijah. Look at it this way. If I buy stocks and my stocks are down and they're going to go down the next 12 months, am I better off to take a 3% yield on a 1-year treasury, even though I'm behind inflation a little bit, or would I rather be behind inflation and lose 10 or 20%? So the way I look at it is, yes, you could look at it that way, but you're not going to find anything that's going to keep up with that 7 to 8% inflation we have right now. Not right now, and so in order to get around that, you're going to have to be okay, I should say, with cash. Now, we own things too. We just have a lot of cash. Most of our accounts are anywhere between, 45 and 55% liquid, all 3 strategies. So we have other things, but we have a lot of liquidity that buffers, the downside. But I've heard that over the years. I've had people tell me that over the years, like, oh, I don't want to hold the cash because I don't make any money. Well, the bottom line is you're not losing any money. Right now, you need to be working on preservation, not on the gain side, because that's not coming.
And does shorting the market work in your strategy, or what is your perspective on those who are saying, well, maybe we can take advantage of this bear market that way?
You can. I mean, you can if you're willing to. I'll give an example. In our stock strategy, we have 3 strategies. But in the stock strategy, we have some companies that we have tremendous long-term gains in. And rather than sell those, because we want to keep them longer too, rather than sell those and pay the capital gain on it, we just we hedge those off with a short S&P or a NASDAQ. It's not a lot, but it's about 8% of the account. And we look at that in a bear market, we look at it as cash. Now, we don't do it in the other two strategies because they're more income related, but you can do that. I think what people forget about shorting is that when you buy something, forget about shorting a single stock, but let's just say on average, usually you have a core position. Let's say that you take 5% of your portfolio and you get a rally like July, and maybe you take it up to 7%. And then you do what we've done the last 2 weeks, and you take it back to 5. You've got to trade around your core position and not get, not be too much in love with it, particularly on a short.
It does seem like also the environment right now is, as you mentioned, it's important to be able to control risk because there are a lot of unknowns right now. You've talked about before how we're in the bubble of everything. So it's not just the stock market. It's pretty much all the sectors that are overvalued right now. Can you expand on how we got to this point?
Well, it started in 2009 and 10 when they kept the rates really low. I know a lot of people will blame it on 19 and 20 when they really, really juiced it, but it was already here. And for starting in 9 and 10, and over that next 8 or 9 year period, they kept the rates really low, too low, really, relative to what they should have been. And the Fed didn't do anything, and they got caught up in this mantra of, we'll keep inflation low until something happens. But they kept pushing money out. They really bought a lot of bonds. Well, that was the foundation. Then you come into 2020 with this thing, and when they do that, they end up in a situation where they take it to the nth degree level. Unbelievable liquidity. And, you always want to go back to Milton Friedman, who was a brilliant economist back in the day. But he always said, this is true. The only people that can create money and inflation, the only group that can do that is the government. Companies can't do it. People don't do it. But the government does it, and they push too much money out, which is what they've done, and they really pushed it 2 years during 19, 20, and 21. And so that took everything to another level that, it was really off the charts.
And I guess that's where we are right now, is we're just seeing the beginning of the popping of that bubble.
That's true. And what happened is, we've only had, if you go back and look at the history of the country, we've had maybe 4 or 5 what I call super bubbles, okay? And one was 29. One really was 1973, 74. That was a super bubble, particularly January of 73. 2000, to 2003. You can say 08 was a break, but it had to do more with where we were in financing. And everything wasn't at a bubble then. Now, in this last 3, everything's at a bubble. It doesn't make a difference what it was. It was, if you look, real estate, private equity, private companies, art, cars, stocks, bonds, everything was at a super bubble. And when you get 2 or 3 standard deviations above where it should be, then they're going to come back to the mean, and nobody believes it, but they do. They'll come back to the mean, what happens is, when that happens, it catches everybody by surprise because they got caught up in the bubble. And we're going to have to go through this, unfortunately, a period where it's got to come back to the average.
Now, when it comes to, I guess, the bubble of everything, you actually have stated that this time is kind of the worst that we've seen. We've seen a bubble of everything before, but this time things are more overvalued than before. How do you measure that, and why do you state that?
Well, we look at it from a lot of different ways. I'll just take some of the ways we look at it. Like, we're really in the private company market. That is, we work with a lot of business owners after they sell companies. That's where we have a tremendous amount of money that comes into us. We've done it for a long time, since 1984. But what happens is, if you look at the multiples they've been paying for that 2 or 3 year period there for private companies, it was actually stupid. They were paying so much money for them, and we saw so many companies, and they should have sold, because the private equity firm buying them is never going to make any money in that company. They paid so much money for it, they'll never make it. We saw it. Then we see it in real estate. If you look at real estate, if you look at the cap rates got so low, 3%. I'm like, come on. There's a risk to a building. I mean, you have to put money back into it. A lot of things, they can move out. That got crazy. Stocks got really crazy. Your price to book, price to sales, all that was off the chart. Then you bring along and you get SPACs, which have killed everybody, and which they should have. It's a horrible investment. And then you bring in crypto, which is even worse. And you look at all of these areas of speculation, and they are super, super bubble territory. They were. They're starting to correct, but in our opinion, these take a long time.
It definitely does take a long time to correct. And I think one of the things that we've talked about before also are other ways to reduce risk and I guess safe haven assets that are out there. But they often also fall, as you mentioned, when we do see these sell-offs. Last time we talked about gold and silver, and they have fallen since the last time we talked, especially silver. Your take on those at the moment, where it seems like this environment of inflation should be fantastic for the precious metals, but we are seeing them fall along with the stock market.
Elijah, it's interesting. If I had gone back a year and said everything that's going to take place, I would have said that gold will really take off if all these things take place, and they all took place. And we own gold, by the way, so don't get me wrong. But it didn't happen, and I don't know if it didn't happen because at the time, a year ago or 2 years ago, they were getting maybe some competition from crypto. I don't know. I couldn't tell really. But I will say this. I thought back in the spring when I talked to you that when the markets go down, the miners go. We like the miners, but we took some of them out back because we felt like they follow the market down. But they don't stay long. You look at, I'll give you 2008 as an example. Gold came down, the miners came down, but by the time you got into May or June of 2009, you were back running again. It's sort of like that now, probably. You're seeing these miners really get sold down right now. But for the first time in my career, there's probably 5 or 6 of them that are yielding anywhere between 4 and 5% on the dividend. So I think people will start to look at that, number one, on the miners. But they come down because people turn around and say, yeah, I need liquidity, so I'm going to sell anything that's sellable. And that's really where we are today. They're selling anything that's sellable. Unfortunately, the gold miners are there. I think the bullion is better right now to own because even though I know it's down the last 4 days, but it's a better item to own than the miners because people, for some reason, don't sell the bullion as quickly as they do the stocks. That's just the way it is. But if I were just coming into it, we'd certainly, if we get new money today, we're in particularly one strategy we have, the high income strategy, we're going to own, 3 or 4% gold.
And what has to turn around for that trend to shift? We're talking about how, all of this gets sold when the general equities get sold, but what actually changes the trend for precious metals towards the upside?
Well, my personal opinion is what will change it is twofold. I think crypto will go lower. Maybe the top 5 don't get hit as hard, but the other 9,900 or whatever, they just get obliterated before it's all over with because there's nothing to them anyway. But secondly, in my opinion now, it's just personal opinion, so I'm not trying to tell anybody you need to think that. But the second thing is that when people get worried enough, and they're not worried enough yet, that's what I'm saying about the stock market. When they get worried enough, they'll turn to gold because gold becomes what I could call a fear investment. And they get really fearful and they'll own some gold. And we're not there. I think that's 2 quarters out or something, but it should get there.
And your outlook for gold is quite positive for the long term. I know you've said $5,000 gold, correct me if I'm wrong, but why do you see it going that high?
Well, number one, it's hard to find as much as we used to find. And secondly, we watch these periods. If you look at 2011, that was the high. And then you'll go through 7 years or so of correcting and all that sort of thing. But they go in these cycles. And we really have not had a great up cycle yet. Yes, it's higher than it was at the low back in 15 or 16, but not tons. And so what you should get somewhere is some pricing in the next, to me, at least in the next 5 years, it would be somewhere between maybe 3,000, maybe 5,000, but some number that's probably double at least what it is now. That'd be 3,400. But I would guess that you'll get that because I think the fear will come back in.
And then your perspective on silver, are you more bullish on gold or silver at the moment?
Well, Elijah, we don't own silver. I always look at silver as a little bit more of an industrial metal. It does have tendencies like gold, don't get me wrong. And the silver-gold ratio right now is obviously skewed in favor of silver if you're looking for the cheaper. But if you look at it, silver is used a lot industrial as well, and gold is to a degree, but not like silver. And so, it's an okay. We don't own it, but I don't see a problem with it. I'll put it that way.
Is your anticipation at all that it'll get hit as we continue further into this recession and economic downturn? Yeah,
I would think so. At the worst, or the best, I would say it wouldn't go up a lot. I mean, it doesn't have the following that gold has, but it has its place in time. I don't know that it would be something I would own the next 6 months, but it certainly, when you turn the corner and start back the other way, silver will be something to own.
All right. Well, Ted Oakley, we really appreciate your time today. If you could share with our viewers kind of your macro view again, highlighting really what investors should be looking at right now.
Well, Elijah, I think what people have to understand is that, and let me say this, there's a lot of people in this business that have only been around for the last 12 years or so, 10 or 12 years. And unfortunately for them, there's two things they've never seen before. They've never seen inflation, and they've never seen a longer extended bear market. Yes, they got a bear market for about a month or 40 days in March of 20, but you have to realize how many people are in that slot. And so they've all been taught, this is the mantra they've been taught, which is just buy it and hold it and put it back and you'll be okay in 5, 10, 20 years. Well, the problem with that is when you go through, and this is why their inexperience will kill them. When you get into a situation where in an extended bear market and you get down 50% or 55% and it's over, then you've got to wait the entire time. You've got to go up 100% just to get back where you were. Most people do not have the fortitude to do that. Once they are starting to get wiped out, they turn. So my advice to people from a macro standpoint right now, and I don't think you'll lose a lot by doing this, is to increase your liquidity higher than you normally would have it. Don't do anything with it. You can buy a 1-year treasury or 6 months treasury, but don't do a lot with it. In other words, that needs to be iced. And then give yourself some leeway because eventually we will have a really serious low that is a great opportunity to buy things. But you got to have cash when that happens. And so I always tell everybody that, you don't need cash till you need it. And so when you really get to a point where you need it and you've got some of it, say half your account's cash, you'll be surprised at how quickly you can make up the ground you lost over the next 2 or 3 years after that. But that's where we are right now. I think it's a classic bear market. I think most people don't realize that because they're too young. And I'm not knocking youth, don't get me wrong. But there's an experience side of it that you got to see this coming. And I think that's where we are. That's my advice to people now.
No, I think that's so true that I think experiencing the economic environments is so important. And yeah, I mean, as I'm seeing gas prices go up, especially at the beginning of the year, I mean, it wasn't something I personally had ever experienced before. And there definitely is a mind shift there of like, inflation is real and we have to protect ourselves against that. But Ted, thank you so much for joining us today. Any last thoughts before we let you go, and where can our viewers find you online?
Well, I don't really have any thoughts. I will say that I've been in the business a long time, so I was around when you had even and odd days on gasoline that you could buy gas, depending on your license plate. And that was when things were really soaring out. And then I spent a long time in my early part of my career in inflation, and so you had to really know something about what you were doing, or you would just get eaten alive. And it's interesting. We went a long time without that, but now it's coming back. So it's like kind of like old times for me. I know what I'm looking at. But again, I couldn't stress enough to people that now's not the time to try to be a winner in something. It's really the time to preserve. And, you're not going to get hurt. The trains, there'll be a train leaving every year, so you'll be okay. Just try to give yourself some preservation until next year.
Ted Oakley, thank you so much for your time, and God bless.
You bet. Thank you, Elijah.